Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Today we're tackling a very common investing mistake, selling equity too soon. Why does that happen? How can you handle your short-term liquidity needs? All of that we'll cover in today's episode with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
So, Dhirendra, you must have seen this play out with thousands of investors. They end up selling their equity investments prematurely. Why do you think this mistake happens?
Most investors confuse liquidity with safety. What you can sell and you realize it quickly, you think that it is more secure. Safety actually is lying there, is rooted in the character of the asset. You have investments which never go down in value. And that should be your short-term destination. You will get less return, but it will not be dramatically lower than what you put there. And that is primarily the reason why so many people have their money parked in fixed deposits. That is, many a times it is their long-term money. But they can realize it any time. They think it is safe. And there the problem is that, long-term money in something very secure and liquid, and putting your short-term money into equity with the misimpression of that being very safe because it for the short run. That I think is something which requires a lot of understanding. It requires really absorbing this issue that it's almost like, buying a house and you don't sell your house for your day-to-day expenses. It's an asset and you hold it for the long run. I do come across many situations, many people who are asset rich and cash poor. They will have big bungalows, they will have big assets, they will have good ancestral, inheritance. But when it comes to money for day-to-day living, money for day-to-day expenses, or some emergencies and other things, they just may not have the money. The money that you are likely to need every month, there should be absolutely no ambiguity and uncertainty about that money hitting your bank account every month on first.
So to avoid this asset-rich, cash-poor kind of scenario, how should investors think about their long-term money versus their short-term money? And once they've identified the short-term needs and long-term needs, where should they park this money?
One is that, be reasonably sure about your regular planned expenditure and have a cushion. You might need, a lakh of rupees a month as a household expense. Make it 1,10,000 and prepare for it a little bit more than that. Then, emergencies. If you have stopped earning regularly, if you have, stopped getting your salary, regular income, then, you need to plan for those emergencies if you don't have those cash flows coming in. With that in mind, so having that 3-4 lakh rupees lying somewhere which can be accessed anytime without exposure to the market. The money that you are likely to need every month, month after month, what have you done about it? Is it parked somewhere? Are you getting some pension? Are you getting some rental income? The nature of that. If there is an asset which is producing that income, nothing like it, then have some fallback that just in case, you have a tenant, he is giving you the rent, but then he just might vacate it. And what is the fallback then? Do you have an asset which you can realize or something? So you have to work on some little bit of, apply your mind little bit on that. But the money that you need in the foreseeable future in a predictable way should be lying in your bank account or a liquid fund. Liquid fund which will earn you, little more than bank account. And you can take out only as much as you need every month. Keep it in liquid fund simply because, the money which you will not take out will continue to work. Unlike fixed deposit, where the money, the moment you move it to your savings bank account, it stops, earning as the higher return that it was getting as a deposit. So it's almost like a deposit kind of return. It is reasonably secure. There's rarely a liquid fund where on a weekly basis you will never have a negative return. There has been once in a while, there are days when the liquid fund doesn't go up in value, but that's about it. It never, occasionally, once in a while it has happened that on one day to another, the value of a liquid fund might have gone down by 1 paisa, not a percentage. So depends how much it will be. So that is a reasonably, secure way of doing it. And letting your monthly requirement lying in the savings bank account, don't over-optimize. Don't make it work too hard. The money that you need, so you need to make your long-term money work harder.
Yeah.
You need to make your medium-term money work harder for a goal which could be little negotiable, or you could be little flexible about.
So, savings account and liquid funds for immediate needs.
For immediate needs.
What about the ultra short term funds or short term funds? How
For
do
your
they help?
medium term, there are a lot of people who need to have your emergency fund. Emergency fund which actually just might show up. You're planning that, okay, there could be a surgery planned or maybe not, but having 3 lakh rupees or 5 lakh rupees handy will be useful. But there is a likelihood that the money may not be required. That money should be parked in ultra short-term bond fund. There, the likelihood of getting little higher return than fixed deposit with reasonable safety. At the same time, the likely risk of loss it gets reduced substantially. So that's the way to go. They are liquid, they are secure, and they, also I think that, even for lot of long-term equity investor, I keep suggesting that you should have some fixed income. There are two needs for fixed income. One is this short-term needs. The other is the medium-term needs for a planned goal. And the third is to bring stability to your portfolio. Your market goes up and down, and your whole investment of, assuming it is 1 crore, it goes down to 90 and then goes up to 1 crore, and it creates lot of anxiety. Lot of investors will be much more comfortable if the scale of up and down it gets reduced by half. Assuming that it was going up from 1 crore to 1 crore 10 lakh rupees and coming down to 90, you'll be much happier if it goes up to 1.5 crore, 1.05 crore and comes down to 95, and you'll be fine with that. And that can be had by having 25%, 30% into fixed income. And that brings the overall stability and also creates a mental comfort that the money that if you have to lay your hands on your long-term investments, you have the fixed income from where to take it out.
For asset allocation, you always say hybrid funds are a better choice, but for stability, and if you need to dig into that money, in that case, short-term bond funds and ultra short-term
bond fund and is good enough.
Okay, and how big should this liquidity buffer really be?
It is not up to me to answer it. It is for everybody's situation is different. If you are a retired government employee who will be getting your monthly pension, you need to prepare less. If you are a central government employee who will be getting a central government health scheme, where any big medical expenditure coming your way will be taken care of, you need to prepare less. If you have a rental income coming from some asset, you need to think about it differently. You will not have any pension income. You need to think about it even more intensely. If you have carefully chosen a health insurance, which will make sure that in case of a very difficult situation, you will still be taken care of. Then you need to prepare a little less. Then depends, what are your plans? Your income plan and your expenditure plan. Your planned expenditure. If you plan to really travel the world twice a year, you need to prepare for it. So it entirely depends. It entirely depends on your own context. But when preparing for these things, think liberally.
But this is for someone who's already retired. What if someone is still working, and how do they need to plan differently?
Sit with a pad and pen and think in terms of tomorrow when you stop working, what is going to be your essential expenditure, and what is your wish list which you would like to spend money on, and look at the cash flow. How much money you need at what stage, what the money that you need every month, the money that you need every year, and the money that you need every month. Just multiply it with 1.25 times. Because we will always be conservative in estimating that. And we will not be factoring the inflation there. And think in terms of what you need today is 100 rupees. You will be needing 125 rupees 3 years from now. And you have to keep that into mind, err on the side of caution. And also be little liberal in your estimation of your expenses.
There's also this mindset that keeping too much in liquid assets, it's a wasted opportunity. What would you say to that?
It could be a wasted opportunity if you're still working, if you become too conservative, if you keep a lot of deposit, lot of liquid fund. Getting too scared is also a risk. Be little prudent about things In your income years, be aggressive as possible. And as you get closer to your retirement, when your income stream will come to a halt, when it stops, that is the time when you should actually become conservative. But conservative not in terms of move all your money to fixed income. That is not the prudent thing. Your investments or lifetime accumulation has to provide for the period. That could be a very long period of your non-income phase.
Does this also help with psychology, giving psychological comfort? And
in India, the scale of investment is growing. The lot more people are doing SIP. Lot more, there's far greater investment in mutual funds than in equity funds today. But when you look at the holistic picture, the scale of money lying in public provident fund is phenomenal. So the lure of fixed deposit, and the other is the lure of savings bank account and fixed deposit, which is accessible anytime. The charm of liquidity. People think that what is liquid is the safest thing, and it has turned out to be true. In India, it is. Don't keep it all liquid. In fact, the safest thing is to keep money in your locker. And that will be the most dangerous thing to do.
For someone listening right now who has already been dipping into their equity investment for short-term needs, what is the first corrective measure that you would suggest?
Make sure that you have 3 months of income requirement lying in a liquid fund or your bank account. Don't over-optimize it. That is the sacrosanct money. You are not supposed to touch it. The moment you are able to prepare this foundational thing, that this is my emergency money, for this I will not have to go and sell my equity. Because when you go to sell your equity, that could be the day when it is down 5%. That could be the day when it is down 3%. And the moment you realize the loss, the moment you book the loss, it has a devastating effect on your mind. You will always be scared, and your experience will always drive your future expectation from equity that it is risky. Equity is risky for the short run, and equity is not risky for the long run. And for your short run need, if it is not covered, equity will keep blowing up for you.
All right, so equity works only if you stay invested, and you can stay invested only if your short-term needs are taken care of and planned for. Now, moving on to the viewer's question. It's a longish question. Mihir Patel writes, I have a mutual fund portfolio of about 2 crore rupees with long-term capital gains of 1 crore rupees. The investment horizon is 10 years and I assume 12% CAGR. With the new 12.5% long-term capital gains tax on 1.25 lakh rupees exemption per PAN, I'm considering 2 options. Number 1, do annual tax harvesting, redeeming and reinvesting up to the exemption limit across 3 PANs in the family. And number 2, do nothing and let the money compound, paying tax at the end. So by my calculation, he says, harvesting could save about 9 lakh rupees in tax over 10 years. Do you recommend this strategy? Also, are there any risks in using multiple PANs or better alternatives like staggered withdrawals or rebalancing?
There's a clear payoff in terms of a small entitlement available every year. 1.25 lakh rupees of capital gains can be realized and you are not liable to pay any tax. And if you're a long-term investor, if you are able to methodically do it for the 3 members in your family for the 3 PAN, as the investments will be spread, you'll be able to realize 3.75 lakh rupees worth of gains every year. And over a 10-year period, that translates into this whatever benefit. If you can do it with ease, this is something which is lying on the table. And if you will be troubled by doing this, if you are a little lazy after redeeming it, if you are trying to time it after you have taken your money off, if you have difficulty in filing the tax return with the capital gains and other things, let it be. Because there's a charm of letting your money work, and if this investment portfolio is such that you are in the accumulation phase, and in the deaccumulation phase you will be realizing a part of it periodically, the tax liability will not be very significant because your income will stop and you may not be liable for as much taxes.
Thank you, Dhirendra, for answering all these questions.
Thank you.
And thank you for sending in your queries. Keep them coming because most of our Investors Hangout episodes, they are based on your queries. We'll keep answering them. You keep sending them. Thanks for watching. Bye for now.